it can be a great cocktail party. If that's a thing people still do, I don't know. It could be a great cocktail party discussion for you to feel like you're the financial guru and be like, well, yeah, but this rate's above that rate, and so I'm playing the
Wait, are you
market. And this
speaking from experience here, Dougals?
This podcast contains the arguably witty banter of two friends, Skippy and Dougals, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Skippy.
Dougals, do we have listener mail this week?
What are you talking about? Do we? Yes. Do we have listener mail this week? We do. Before I hop to it, go rate and review the podcast. Love you all that keep doing that. Love seeing those come in. Thank you.
The other thing I want to mention is that we love our premium subscribers, and we put out some special content for you guys this week. So don't miss that in your inbox there. Hope you enjoy that. Send feedback our way.
All right. Listener mail. We got two pieces going to cover here. One, and I promise you that I didn't send this listener mail in.
I know where this is going.
I promise you. We had John sent in some listener mail about Cathie Wood. Was not me.
We got Dougals over there making up fake email addresses and calling himself John so you can talk Cathie Wood.
Thank you for sending this in. In short, it's Cathie Wood coming out, and she's become a permabull, is all I can say. I didn't know that was a thing, really, but she comes out and she's saying that the NASDAQ 100 is not true innovation. She is true innovation. So unlike what the NCAA is talking about in their commercials with their frozen people getting hit in the face with the elbows and whatnot, she's saying we're true innovation. Quote unquote, if you look at the S&P overlap with the NASDAQ 100, it's gone from 12.1% in 2002 to 42.7%. So she's like, basically, it's all the same. You're looking at I'm going to still call it FANG because I don't know what the new acronym is, or whatever. Yeah. The FANG companies are taking up so much that you don't have the raw innovation that you get from ARK. So that's what she's saying. What this piece that John put in is also saying, so it gives Cathie Wood her time, and then says, and so year to date, the ARK funds have respectively returned negative 37%, negative 33%, negative 35%, negative 31%, negative 19%, negative 10%. Those are all six of the funds. Now, short-term performance, right, is short-term performance. These things could turn around if she's right. If she thinks they're going to go up by 20, 30-fold, I'll take a negative 30% to then go up 30-fold. I'll do it. But question mark.
Yeah, so you know what I learned this week? Innovation sits with Skippy because I'm outperforming all her funds, and I own grocery store chain in Pennsylvania and
innovative
a towing company.
Innovative.
I mean, according to short-term performance, right? I'm so innovative. This is, I don't know. It's just endless Cathie Wood. So the overlap point is interesting, right? But it's just, okay. The other thing with Cathie Wood, you called her a permabull. I heard Morgan Housel say this week, like, you know what? It's kind of nice to have at least one permabull out there because everyone's used to the like Grantham like perma bears that are always like the world is going to end. I guess at least she's consistent on the positive side, and maybe we should embrace that.
Yeah, I guess, except that permabull might be aggressive because she's talk your book permabull. She's not saying the markets are going to go up. I think she could care less what happens to the market.
She's just saying my
research will never go down except when it does. Is kind of what she's saying. And this is just year to date. We're not talking about drawdown, right? Which I think the drawdown for our funds is different. I don't know what they are, but because I don't
much worse.
I don't follow Cathie Wood. I don't look at it, so I don't know. All right, second piece. Thank you, John. Second piece of listener mail comes to us from Charles, and this is sent over a tweet. And this tweet says it's from Connor Sen. It says, if you've got a mortgage at 2.875% or below, it's now possible to buy treasuries that yield more than the rate of your home loan.
What a time to be alive.
Fascinating.
Is he talking about the 10-year here?
I imagine so. I didn't check it out. That's
it's fine.
That can't be like the 3-month.
Oh, so listen, I have people I mean, I don't claim that the show is widely followed enough that I'm anywhere near a celebrity, but I swear I have people shaking me down, like on the streets, just yelling iSeries bonds at me, Diggles. It's so great. It's just like everyone loves these things. Everyone is so excited to see rates come back. Now, the flip side is that's because of inflation. But, oh, there's some intriguing possibilities. I feel like it's a brave new world. I'm just so excited about it.
I don't know if it's a brave new world, but it's some kind of new world. We've already been in a new world. We've been in a scared new world. Maybe that's where we are. I don't know.
Yeah. Now the logistics of, hey, listen, if you have a mortgage, but you were actually sitting on enough cash that you could have paid off your mortgage and you choose to invest. Like, I don't think that's happening in the real world. Maybe that's 1% of people.
I mean, you'd have to take advantage of that arbitrage.
Yeah.
You have to be, it's like a massive amount of cash that you have to be playing with. You have to be like, instead of paying off the mortgage of my $100 million house, which I have at 2.75%, I'm going to buy $110 million in treasuries. I don't know. It's a wild thing, but it's fascinating from an academic standpoint.
The last thing I'd say there's like, it's worth monitoring and thinking about in your process, because you're going to have effectively risk-free returns that are like nothing in the last decade, and maybe in some cases in the last 40 years, if you talk about iSeries bonds and stuff. So it's worth considering that as you reallocate cash in 2022, yep. Right?
It is. And since you said the last thing, the last thing I'll say here is don't get cute. What I mean there is, it can be a great cocktail party. If that's a thing people still do, I don't know. It could be a great cocktail party discussion for you to feel like you're the financial guru and be like, well, yeah, but this rate's above that rate, and so I'm playing.
Wait, are you speaking from experience here, Diggles?
That was real good. I got nothing. But yeah, don't be that person that's just like trying to be the clever one, and so you end up trying to play this arbitrage, and then somehow you get messed up. Remember that your house is debt. Like, that is debt that you have, and think about that as debt. But just know that this is the case. Do your own homework, do your research, and make smart decisions. But it's fascinating.
Wait, can we, this is really out of character for me, but can I hammer that home with a point of my stupidity?
Is the last thing?
We're switching gears here. This getting cute. I was monitoring some of the, because crypto is a hobby where I don't have any real money, but I like to, it's like a learning. It's like I'm paying for a degree to better understand that space. So a few months ago, I saw that some coin had, I think they call it an APR, but it was returning 4.5%, right? And I did some research on the coin, and it was like, it'd been fairly stable. I was intrigued by the possibilities. So I threw $100 in the coin, right? Like, literally 3 days later, they magically cut the rate from 4.5% to 0.05%. And
so just it's tiny deduction.
And since a bunch of idiots like me had the same hypothesis of, oh, here's the easy way to get 4.5%, the value of that coin against the dollar went down like 30%. And so all of a sudden, where I thought I was taking $100 for fun and making $4 over the course of the year, like 2 weeks later, my $100 was worth $70. So that's the I'm being cute type of thing, where it's not even worth it.
Don't be skippy, people. Don't be skippy.
Yeah,
that's the.
If you do it with $100,
yes,
and chalk it up to being an idiot. So
exactly. All right, fishbowl dive in. I'm gonna go in and pull something out from Not Boring Co. It's been about a year or so since Not Boring Co. was some content that we dove into. We did an ode to Excel about this time last year. And so Packy McCormick writes this blog, Not Boring Co. This post is called The Current Financial Thing. It's a play off of The Current Thing,
yep,
which is a meme that's been sent around. Have you been following that? Or have you seen that meme? Not been following it. I don't know how you really follow that, but you've seen that around. So the idea here, if you if you haven't seen this out there, is the current thing is saying that there's something that's happening out in the world, and there's a consensus around the attitude that a given population effectively would have with it. So an example of that as of late is with the Russia-Ukraine war, right? That's the current thing. And one of the things that he writes really long posts. So one of the things that Paki says in here is that with the current thing, it can often be clearer as to where someone falls. And like the downside of actually being against the current thing can be pretty high. Again, depending on where you are, but Russia, Ukraine is an example. But he's saying
the context there is kind of like the way it's been presented is like the current thing becomes something that the masses expect 99% of people to immediately agree with without, like, there's no counter. It's like, I hate to do this with Ukraine because I do think that's pretty obvious, but it's like, how could you not support Ukraine? Yeah. So, but I think the counter argument that some people are expressing is like, it's weird to just accept compliance. Like immediately say, with this issue, whatever the issue is, the only appropriate perspective is this one perspective.
That is true. And what he's saying along those lines is that there's limited upside to being against the current thing.
Yeah.
Like it's kind of because of what you just stated. Like I think that was stated really well. Because of what you just stated, there's limited upside. Whereas the current financial thing is upside, often where people make the money. Right. And that's kind of like a premise he comes back to in here. One quote that I'll give from this that I think captures that pretty well is, we can find many things worthy of our support. So many, in fact, that it just makes sense to outsource our intuition for which events matter most. That like with the current thing is what happens. Like it's folks are saying this, I'm outsourcing, right? My intuition of saying like, basically the world has told me this is the thing. But with the current financial thing, outsourcing your intuition, you can ride that for a little bit. But if at some point, right, if you're only going around with the crowd, then the crowd goes up, you might go up, crowd goes down, you might go down. And that might be cool beans, right? For the vast majority of people, that might be the thing you should do. Yeah. But if you want to make those outsized returns, and the example he gives here is Renaissance Technologies, which we talked about before. If you want to make those outsized returns, you got to go against the thing. So Renaissance Technologies is an investment firm that was founded roughly 40 years ago, 30 something years ago, by Jim Simmons. We've discussed that on the pod. It has the best performing fund of all time, at least of its size, right? Mm-hmm. Of like roughly its size. The original fund, the Medallion Fund, since 1988 has generated 39% annual returns net of fees. So, and these fees are not really fees. They are usurious. Like they're massive. The fees that Medallion Fund has is 5% management fees. So that means you have the amount of money that is invested in the fund. They take off 5% just to run it. Like that's like, no matter what happens, they take 5%. And then 44% performance fees. So 5% out the get, and then 44% of whatever it returns. That's massive. And so after all that, it's 39% a year. Massive.
I mean, this is my favorite story, and that book's amazing. I've talked about this before, so I won't bore people with it too much. But this is how you truly know someone's like cracked the code. They started the fund with outside money, and I forget how long, Douglas, but like 3 to 5 years later, they were like, oh, we're done taking outside money, because they just wanted to make their partners wealthier, and they truly had something. You couldn't run, whatever, trillions of dollars in it because there's only so many arbitrage opportunities, but they had something with almost as close as you can get in this world to guaranteed outsized returns. And they just wrote it. I mean, they just said, we're going to do this with our own money and be happy as can be.
And they're riding it. As someone once told me at a poker table, I was sitting next to, poker player, I was sitting next to this guy in Vegas who I've actually played poker with a good amount. Back when I was in the Bay Area, we'd play poker together down at when I say play together, we didn't really know each other, but we would show up at the place and just play with them.
See each other.
We're in Vegas. And so in the Bay Area, went to Vegas one time. He's sitting at a table with a couple other folks that were from there, sitting next to him. And he says to me, after maybe about an hour of play, it became fairly obvious who at the table was trying to punch above their weight class. Let's just call it, right? It became very obvious. And he says to me, he goes, when you find that person, you just sit on them and you ride them like Seabiscuit. That's what he said to me. And this is one of those circumstances. They found their Seabiscuit and they started riding it. And where it maps back to the point of the current financial thing and being contrarian is, according to the Post, which I hadn't thought about it in these terms before, it's saying that really what the Medallion Fund is doing is your favorite thing, which is it's betting on reversion. So mean reversion is effectively the strategy. And one of the signs of that here is that it's playing off of when human psychology is most at its like fluid, I'll say, where people are like, they're fearful, things are up and down, is where this fund has made its most money. So the top performing years in the Medallion Fund, the 3 best years were 2000, 2008, and 2020, when it gained 98.5%, 82.4%, and 76% respectively. Can you imagine in the year 2008 having an 82% return when the market was down, what, like 35, 40?
It's a nice place to be, man.
So that I think is a great example of the current financial thing there. I'll pause, get your thoughts before maybe throwing out one other detail there.
Well, it's funny. He also references the All In podcast where they talked about the current VC market and some concern around the macro environment there, and how is it a startup called Fast, Dougals, that just went under?
Yep. That raised buku wuku. And then went druku duku down into the twilight.
Yeah, so they talk a lot about run rates and stuff. Actually, I may be referencing a slightly different episode than he referenced, but it's a similar conversation. I just thought that was a very interesting listen this week.
They had 2 really interesting parts of that discussion that you just mentioned on that episode of the All In podcast.
Yeah.
There's one around Fast specifically, and the discussion they had there was around governance of who is responsible for this nonsense. Because Fast, don't remember the exact number, but Fast raised something like $150 million. It was a sizable amount of money. Raised $150 million, went out of business, right? Had to close up shop. And that $150 million was raised like 12 months ago. I mean, it wasn't that long ago.
Yep.
Right. And so by simple calculations, you can say they were burning somewhere over $10 million a month.
Yeah.
Burning
their run rate was crazy. I mean, and there seemed to be no like just common sense about, guys, we're not bringing any revenue in the door, or if we are, it's pennies compared to the 10 million we're spending a month. Like you can't spend 10 million anymore. 6 months ago, maybe even more, you had to be like, okay, we can spend 3 million a month instead of 10 million a month.
Yeah, exactly. I think it said they were bringing in something like $100,000 of revenue. Like I can't remember if it was a month or a year. It almost doesn't matter which of those it is when you're looking at that. So when in net, so when you take revenue and costs, like net burn rate, $10 million a month. And then the other thing they said, which I thought was really fascinating, is even if you're doing that, because maybe at first they're saying, we've got this phenomenal product. Let's go hard. We'll grow it. But when you get to the point where you have 3 months left, you've done 9 months of spending. And they said, well, at that point, they still have $30 million, which is a big amount of money. Like you have to make, this is not easy, but sometimes you have to make those hard decisions where you go, okay, we have $30 million. We're bringing in 100,000. I did the quick math, back of the envelope. That doesn't work out. And like, we have to change our cost structure. Right. So that was one fascinating part, was around governance. The other part, and this is, we're transitioning off of the current financial thing right now, was around the current state of venture capital funding.
Yes.
There, from between that, and I also read this TechCrunch article about this recently. I think there's some really interesting points on it. What did you pull away from that? Because I think you found.
I mean, I don't follow like the VC world anywhere as closely as you, but to be a fly on the wall for that conversation about, that's probably a leading edge indicator of a coming recession, right? If the VCs get tight with the money they're willing to invest, it probably speaks to other things happening in the macroeconomic environment. So their tone in how they talked about how difficult it is to raise funds right now, and how if that means that every startup founder should be carefully attuned to their burn rates, tying back to the previous conversation. Like, that's really interesting for me to hear about, because I think it speaks to what might be on the horizon.
Yeah. And even more specifically, it wasn't just that it's hard to raise money. It's more that it's hard to raise money at the same, what they call terms that you did before. And so terms are, if you just think about, you go to the venture capitalist. So I'm a startup founder. I want to raise money so that I can fuel my organization. I'm going to go to the venture capitalist and say, here's the amount of money that I need. And the venture capitalist will say, that's in the case where they say yes, they'll say, yes, we'll give you that money and we'll give it to you under these conditions. Those conditions are the terms. And over the past few years, let's call it up to a decade, but past 5-10 years, those terms have been loose for startups that were growing quickly. And so you get loose, meaning you get high valuations, just like in the public equity market. So you get really high valuations, and you also get the lack of structure, so they're calling it. And so the structure are like the real details of the terms. So when you get terrible structure, like let's go back to, I wasn't like a founder raising money back then, but from what I've read about, when you go back to like 2002 as an example, where that's in the period where tech was starting, like people were like, I don't want anything to do right with technology. Yeah. If you're coming with to request VC funding, VCs are giving hard structure. An example is something they call liquidation preferences. And so liquidation preferences are, if I raise $100 million and then I sell my company for $200 million, a liquidation preference would be that the VCs might say, if you have a 1x liquidation from that 200 million, you give us back the 100 million, and then you can take the rest of it. At that time period, they were going like 2x, 3x liquidation preferences, meaning like if you raise 100 million and you sell for 200 million, you might have to give us 200 million or 300 million, right? And so you're basically, as a founder, you're getting nothing. Anyway, right now they're saying they're starting to go back to having more structure and having terms that are not as founder friendly. And to your point, it's an indicator among many indicators of the state that we're in.
Yeah, thank you for that clarification, because that's very well said. It's probably not impossible to raise money right now, but people aren't as freely throwing money your way, thinking about the next big thing.
Yeah.
If we talk money, Dougals, we got to talk about the world's richest man. We just have to, don't we?
Rich from a happiness perspective or from a money perspective?
I don't know, man. I hope he's happy.
Yeah.
He's happier than Bill Gross, I'll guarantee you that. All right. So listen, I read 7 articles, consumed 2 podcasts, all relating to Elon Musk and Twitter. The way I want to have this conversation is more like where this is over a beer, though. I don't want to like necessarily just recite facts about the purchase price and the poison pill and all those things. I just want to have a free-flowing conversation, because there are so many dynamics here. Like, this might be the most interesting, surprising, not surprising thing that's happened in a long time for me. So I am a fan of Twitter. There's no doubt about it. It's like my go-to newspaper, really. It's social media, sure, but it's the way I consume news. And it's the way that 217 million other people consume news on a daily basis, right? That's the current daily active user count. Now, that pales in comparison to Facebook, WhatsApp, TikTok, 1,000 others, right? The first point I want to pick your brain on before we get specifically to Elon is I heard multiple people this week, in a way that I would say is almost a consensus, say that Twitter has an outsized cultural impact. I'm curious for your thoughts, because I don't think you're a heavy user of it. Do you think Twitter has an outsized cultural impact compared to its market capitalization, compared to its profitability, compared to its enterprise value?
I don't know if I would describe it as a cultural impact, but I think that what's meant by that, I would say yes. I would think of it as the megaphone and power of influence that Twitter has is pretty sizable. And it's different even than what you get from Facebook, as one example. Because what I see in Facebook is it has more of a, like, I would think of, and this is relative to market cap, you're saying, which is much, much bigger for Facebook. But in Facebook, you kind of get the populace Like you influence the culture of like the everyday person, let's call it, in a more dramatic way. Whereas Twitter, you get the expert. Like it's kind of it's a different beast. Whereas like I don't go on Facebook at all, and I go on Twitter sometimes. But if I were to go on Facebook, it's like what does everyone's uncle say? Right? It's like when I get off Facebook. And Twitter, it's like, what does the person that built this or that like
what does the world
that,
leader say? Yeah, what
exactly,
does the CEO, the world leader, the sports star, like, so you know Derek Thompson, who writes for the Atlantic?
No.
I think he's really talented. He also has a weekly podcast called Played English, which I listened to this week with the breakdown here. And I'll get his terminology wrong, but he said he thinks Twitter might be the most important. I don't think he's the word important, but like most culturally significant company in the world. I'm not sure that I'd go that far, but like I said, I heard multiple people talk about this as part of the potential acquisition of Twitter, of like how it's the place that presidents, obviously the most famous president has been kicked off in Trump, but it's the place that world leaders and cultural superstars and company leaders go to not only like break news, not only to tell their own story, but also interact with people. I mean, I can't tell you the level of investing individuals that I've like had personal messages with via Twitter. It's just something that's a little different than a TikTok or a Instagram, and I don't know why. But the reason I wanted to talk about that first is that's an overlay to some of the emotions that people have about Musk trying to buy the thing, because I don't know that your average person really cares about if it's 40 billion or 50 billion or 100 billion for that matter. I think your average person says, oh, I see the cultural significance of this platform, and I have some potential concerns about one individual who happens to be the world's richest individual, which has a whole other there's a whole other part of the story there, owning that and so-called controlling the public square conversation that's happening there.
It's a big deal. I mean, it even goes back when we were talking about Elon last week, and we asked the question of what should the government, maybe not what should it be, what is the government's feeling around someone that is this powerful, being able to put their funds to whatever use, right, they want, whether that's starting another country, which I speculated on, right, or otherwise. And it's similar. It's saying, look, what is the people, what should they think about this when you have that much money? And especially it's like, it's new. This is nouveau riche, to a certain extent, right? I mean, he was rich a couple years ago, but a couple years ago he had like 10 or 12 billion dollars, again, which is ridiculous. It's a lot of money.
But now it might be 200 billion. I mean, it varies all the time because it's mostly Tesla stock, but it's a ton of money that appeared very, very quickly.
Yeah, exactly. And so how much of that is real or funny money? Funny money meaning in 2 months, could that drop by 60%? Possibly, right? Given how fast it came up. So it's interesting from that perspective. One thing I saw, and the source of this, people will have their feelings about, but on Twitter, I don't know if there's a politically correct term, but the Winklevi, I'm not sure what they like to be called, but the Winklevoss twins, they are the individuals that sued Facebook back in the day because they're saying that Mark Zuckerberg took their idea. So, but I saw a couple tweets from them, which I think it's an interesting discussion point, independent of whether or not you agree with it. Is the point that they brought up was that you have potentially someone that could be named as the most successful entrepreneur of our generation. You could potentially say Elon is up there, right? When you have his involvement in PayPal, as tumultuous as that might have been, involvement in PayPal. You have SpaceX, like him basically saying, I'm going to combat NASA, as we mentioned. You have Tesla, of him going to a place where it's like, yeah, no one has created a car company that's been successful in a long time. I'm going to do it in a effectively brand new way to save the planet. Yeah. Someone's done all of that in a pretty short period of time. And then you have, this is from a business standpoint, not cultural, business standpoint. You have Twitter, which if you go back the last decade, it's been public for about a decade, is at its IPO price. So as effectively created no value from the financial perspective, market cap perspective.
Yeah.
You have the most successful entrepreneur that comes to a company that has created no value. Let's just take it at the objective terms of that. And for the board's reaction to automatically be, let's put out a poison pill to have this person not, they said, what is the fiduciary responsibility of a board like that to not really consider it? I think it's interesting. I think taking the cultural side and that side together are really fascinating.
Well, there's so much there, but this is exactly where I wanted to go with the conversation. So one, I have a slight correction / nuance I want to talk about. To say they've created no value, I take issue with a little bit. I think you could say they mispriced the IPO potentially, but like if you look at almost any metric, Twitter is a really impressive story over the past 10 years. It's just the stock price doesn't necessarily reflect that. So you can say either the IPO was crazy mispriced or it's currently mispriced. I've owned Twitter in the past. I have a little bit of Twitter at the moment too. So like I definitely see some potential there as an investment and think it's undervalued. But let's go to this, Dugos. I was texting you this midweek. I have never seen, and I'm sure it's happened before, but just like in the potential acquisitions I've followed, we talked about this 6 months ago. Typically, the stock is trading for $40 a share. Someone offers $60 a share. This is a hypothetical example, not specific to the Twitter value. And the day that acquisition cost is announced, the price goes from $40 to $58 a share. There's a small delta because it's uncertain if the acquisition will actually go through. And then when it goes through, it closes at $60 a share and everything's done. In this case, after he announced, after the world's richest person said, I'm willing to pay $54.20 in cash, the stock price went down from like $48 to $46 a share, representing something like a 17% delta. That's crazy.
It is. It's absolutely wild. And there's some nuance to that too. But I think it feeds into the question of that story is that it was announced and overnight. So like the stock performance overnight in pre-market trading was up like 15%.
Yeah. And
then it opened at like up 5%. So at the beginning of the market, and then by the time the day was done, it was lower. And so I think that there's probably a lot that could happen in there. But a question that I ask, which I think feeds into part of your confusion, is who was buying or selling when?
Oh,
right?
There's something going on there. We talked about that a few months back too. And like the stuff that's happening after hours has been pretty peculiar recently, not with Twitter stock, but with a lot of stocks. So, okay, then the stock actually goes down. And here's my hypothesis. I just, again, have never really seen this. So one, he throws in a 420 joke, which is Elon Musk. And I think that makes everyone think this is kind of a joke. But $54.20, I didn't actually even think anything of it until the entire internet started making jokes about it. But Elon has done a bunch of 420 jokes before. So that's part of it. Another thing is he says he's willing to pay cash, but financing has to be figured out, basically. Like, so who else is going to buy the thing? So that's that. All the shareholders appear to do a massive eye roll to his offer. But his offer is only about 25%, well, somewhere around that, in the range of a quarter of his wealth. Like, it's not like this was me who lives in, who's just some average guy being like, oh yeah, I'm going to figure out how to secure $50 billion. No, it's the world's richest person whose wealth is far greater than that. So he can get the money if he wants to get the money. I know there's logistics to sell the Tesla stock and everything else, but come on.
He wouldn't even have to do that. He could go to, there's like a number of private equity folks that he could go to and get, like he could get the funding. I would have no doubt that he could get the funding, to what you're saying.
So then the board doesn't like it. Not to make it political, but it seems like the left doesn't like it because they are worried about how he might change the censorship rules on Twitter, and Twitter has this outsized cultural impact. That's all fairly interesting. Fast forward to the board adopting the poison pill, which was created in 1982 by some crazy lawyer when hostile takeovers were a hot thing, right? And Douglas, I don't claim to be an expert here, but for the listeners that might care, effectively the way it's written in their bylaws is like, if he gets more than 15% of shares, they can start diluting shares like mad to other shareholders that aren't named Elon Musk at discounted prices. So effectively, that makes it incredibly onerous and much more costly for him to actually get control of the company.
That's exactly right. And to put it in maybe some tactical terms for folks, to give an example, would be if I came and I said, I want to buy that backpack behind you, Skippy, for $100, let's say. And you said, okay, well, there are 5 people that currently own that backpack.
Yep.
And if you say that you're going to buy it for $100, then what I'm going to tell the 5 people that currently own it is that they can spend $50, right, to buy portions of the backpack instead of 100. And so then in order for me to buy all of it, it's no longer $100. It might become $300 to buy all of it, right? Because everything goes up. Yeah, that's what they're doing. It's an aggressive move. And I'm curious your thoughts on, so we by we I mean I said Elon Musk, one of the most successful entrepreneurs of our generation, right? If you take another one of the most successful entrepreneurs of our generation, Jeff Bezos, and you replace Elon, and Jeff wouldn't do this probably, but if you replace Elon with Jeff Bezos, what do you think the reaction is?
It's probably still pretty mixed. Bezos is less well liked than he used to be, but hey, he already owns the Washington Post, and there's another tie in here, Douglas, which is like the Rockefellers and the Carnegies of the world. You know, a long time ago, when you were one of the world's richest people, what you did to control the narrative is you bought a newspaper, and people are making parallels to Musk being like, well, he's buying the world's most dominant and influential newspaper. And then he's going to change the censorship rule. So this playbook it's been done before, and it will be completed in the future. I think this is a natural thing to want to do if you're one of the world's richest people.
Yeah, which goes back to your cultural piece. It's natural and impactful to be able to control that narrative.
There's one more thing I want to get your take on, if you don't mind, related to this. So I keep using the word consensus. It might be wrong, but there's another thing I think I'm hearing that's fundamentally disconnected from the stock price. So Musk says, hey, $54 a share. Silver Lake Partners, who is a private equity firm who owns about 5% of Twitter, is being mentioned. There's some conversation about Twitter might actually open up to bids now, because the board and the major shareholders are saying, sorry, $54 a share is not anywhere near the true value. We're talking 60s or 70s before we're even interested. And just last year, the stock traded in the high 70s, if I remember correctly. So it also seems like there's this consensus with people that know the business well. So one, you have a cash offer on the table at $54 a share. And then the other people that know the business well seem to have a consensus that cash offer is a low ball offer. Yet the thing is currently trading for $46 a share. Douglas, it's just like, someone makes sense of this for me.
It goes back to the point that I was making earlier around the board automatically coming out and saying that we're going to put the poison pill is it's a big deal, because even I know what you're saying, even in the case where you're saying that my statement around not adding value for roughly a decade is wrong because of the financials. If you're an investor that owned $1, whatever that was, a decade ago, you still own $1.
Yeah,
so from that standpoint, it's kind of like saying, if I go back to, we talked about Second Life before here in the metaverse, and I go back to my days at Linden Lab, that company was worth when you leave a startup, you have the opportunity to buy the options or like the equity, right, that they have there. I chose not to buy when I left there. And the reason I didn't buy was because I believed wholeheartedly, and similar to what you're saying with Twitter, that company was worth so much more than the valuation or like the the value of my options. And I also didn't believe that anyone would pay it. And both of those things have to be true. And so Twitter might conceptually be worth well more than it is right now. But over 10 years, the public has effectively voted in their voting machine that is it, right? And
it's a very
both of those things have to be true, right? Now, there's some world where you could create a revenue model, I think, given how influential it is, that would work. But figuring that out, no one's been able to do so far.
Now, I mean, that's all a very good take for me, who is probably jaded about this specific company. But the really bizarre thing on top of that, to reiterate a point, is like this jacket I'm wearing, Dougals. If you came up to me and said, I'll give you $54 for this jacket, and then 10 other people say, oh, I'll give you $46, like, I think the jacket's actually worth $54, which is the current price of my highest bid from the world's richest person, who I know actually has $54 in their pocket.
Yeah.
It's just bizarre. Super fascinating stuff. I appreciate you humoring me on that.
Yeah. Something is worth as much as someone will pay for it. And at
right.
The end, I mean, that's
but not today. Not in the current US stock market with Twitter.
I didn't click on this link, and I wish I did, so that I could have read the article. But I saw a headline this week. Maybe you did click. I saw a headline this week that said that the person that bought Jack Dorsey's like first tweet the first tweet on Twitter, they paid like 2.9 million. It was something like that for this. And then this week, or last week maybe, they decided to sell it, and they put it up for bid at like 200 million. It might not have been that high, but it was like something outrageous, which they thought was going to be like an easy sell. And I think the highest bid was like $111. It was like something egregiously lower. I didn't click the link, but I read that headline. It just went to what we were saying.
If memory serves, it was $277. There were 6 bids ranging from $11 to $277. I'm a little upset about this, Douglas. I may have paid $300 for this thing. Like, clearly the marketing campaign around this was not where it needs to be, because whatever it is, it's worth more than $300, dude. Like,
but something is only worth as much as other people are willing to pay for it.
Listen, we talked about cocktail parties earlier. I'm happy to be the jerk that goes around the cocktail party telling people that I own Jack Dorsey's first tweet. That's worth $300 to me. And I don't even like NFTs.
Except you're just going to go on Twitter, find the tweet and screenshot it, and you'll be good.
Okay.
There it is.
Moving on. Douglas, I want to squeeze in one last thing in my fishbowl, right?
All right.
I sent you this. I think you went through it, and so I want to get your reaction. But there's a look back. I think NPR did it, if I remember right, or maybe it's ProPublica, on the tax cuts that happened in 2003 with the Bush administration, specifically relating to dividends.
Yep.
You know, I had like a very simple point of view here, which is I own stocks that pay dividends, so I like paying less taxes on that. And that is pretty much all I'd ever thought about this. The crazy thing about this tax cut specifically is that it gained mainstream adoption and something that stuck around. So a lot of tax cuts in this country the legislation happens where maybe you make it like a 10-year long tax cut. So it's long enough term that corporations can adjust, but you don't necessarily put things in place forever. Well, the dividend tax cut that came out in 2003 gained popularity with the Obama administration, and it's effectively still in place today, 20-ish years later, right? What I had never thought about before is the outsized impact that might have to certain individuals. So, you know, friend of the show, Bernie Sanders, who always wants to adjust the tax policy in creative ways. Like a simple breakdown, you can dive into the article if you want, but between 2013 and 2018, Bill Gates saved $125 million from this tax cut alone because of the dividends on his Microsoft stock. Larry Ellison, over 100 million. The list goes on. I just never thought about it this way. Like, and I don't think the intent of the law was to give Bill Gates hundreds of millions of dollars.
I think the intent of the law was to give people in Bill Gates' stature hundreds of millions of dollars.
Okay. We can agree to disagree.
Well, it's kind of like when I don't think this hit the pod, but we were talking a few weeks ago about the retirement legislation, right? And had the question. Because recently there's been like the ability for people to wait longer before you have to take the required minimum distributions out of your IRA. And the question of it sounds good to the public broadly. Like the everyday person will say like, great, sure, no downside. But who is really benefiting from this? Because when you have overwhelming agreement or legislation, it's usually that there's somebody with money that is getting more money. And so no one was doing this probably for Bill Gates specifically, but someone was probably doing it for whoever, an heir of some kind of throne or something, or for Congress people or something like that. I think it was for the wealthy to save.
Well, we'll put this on the Twitter. It's interesting stuff. And we really appreciate everyone listening to the show. Thanks, guys.
Thank you.